Hey everybody, this is Brant. We're going to take a look at the market, see what it's got to say for itself this week. For the most context and understanding, I would encourage you to go back and watch last weekend's video. It gives you a lot of context. You can set it at 1.25 or 1.5 speed on YouTube and get through it pretty quick. Anyway, so we're looking at the S&P 500. In last weekend's video, I was mentioning some bear flags that had just started forming towards the end of the week, and then they had started to break down. I thought we'd have a little bit more downside this week, so picking up from there, you can see the S&P 500 right over here. It's 50-day moving average. Let me go to intraday chart. And here's a 15-minute chart, the S&P 500. So there's the bear flag I was talking about last weekend. Here it is breaking down. This 4,500 level has been like a level of gravity for price, but the S&P is lower on the week, so it only ended down about 1/3%. At the week's low over here on Friday, it came within about 1/3% of our measured move for this bear flag. So that's the first leg. Here's the second leg. And as of its close on Friday, over here, it's probably got about 0.8% to go to meet that measured move. And here's the NASDAQ 100 with that same bear flag, a little bit uglier price action. You can see some small little bear flags in here on the week. So it was down 1.6% on the week. Came within 0.3% of our measured move target over here at Friday's low, and as of the close, it's got about 0.7% to go to the downside before it meets that second leg measured move. So as a mixed market, the Dow was up 0.6%. Small caps, IWM, they were down 1.65%. You can see getting close over here to the 50-day moving average. So these technical levels, and that was something that was like kind of a little bit of thorn in my side this week anyway, is that we had these measured moves in a lot of different categories, a lot of different sectors, stocks and stuff like that. But we did have technical levels that were kind of acting as speed bumps. But because these technical levels are so close, I think there may be an opportunity for tactical longs. We'll get into that in a minute. Just like the market averages, the sectors were very mixed. So here's the energy sector. It was the best on the week. It was up almost 3.5%. But others in the cyclicals, like materials, down 1%. Financials were flat. But we did have the banks, like the KBW Bank Index down about 1.4%. Regional banks down 1.6% because we did have Moody's lower the credit ratings for 10 small and mid-sized lenders, warned about risks tied to commercial real estate. If we look at like the mega cap heavy sectors like the tech sector, you can see it broken down here below that 50-day moving average. So that's kind of like an important development. Last weekend, I was showing how many of these sectors had broken uptrends, like trend lines, not just technical levels. But as far as the three mega cap heavy sectors, technology down 2.5%, and that was because semiconductors down 5%. That's a big one. We're going to look at that closer. Consumer discretionary down 1.1%, and communications flat. The mega caps as an index on the week were down 1%, but that is like 100 basis points of underperformance versus the S&P equal weight index, which was flat on the week. So the mega caps got a little bit sold this week. We had utilities up 0.9%, consumer staples barely up, about 1/4, healthcare, which is one of my favorites right now, 2.5%, and real estate a little bit less than 1%. Take a look at healthcare. So this is the 4-hour chart of healthcare, and you see since October rally here, it's just been in this huge triangle, but recently breaking out over here. 4-hour chart, let's take a closer look. And that's a 60-minute chart. So there's the breakout over there. Bull flag, a little bit longer than I would like to see in a bull flag, but again, breaking out in one of the best performing sectors on the week. So we're starting to see that more counter-cyclical defensive positioning in institutional money, and that's what I expected to see in phase 2 as we move more towards recessionary kind of conditions. VIX was really ugly on the week. So on a week where the S&P is down a little bit, VIX was down, 13%. So what you're looking at is VIX in this blue line, and I've inverted the S&P 500's price action over here. So you can see major relative weakness over here in VIX, in volatility. And I suspect that's because technical traders are picking up on those moving averages nearby and thinking, the same as I, that we could get a technical bounce off those. So last week I talked a lot about the semiconductors and how I'd been watching them very closely and them breaking an uptrend. So let's take a closer look at the semiconductor index, SOX. So here's the semiconductor index. Here's the uptrend, multi-month uptrend. And this was the break I was talking about last week. And I said last weekend's video, this looks like a bear flag forming. And of course, here we are this week. And it broke down out of that bear flag. So you have the first leg here, second leg here. This is the measured move right here. So it tagged that perfectly. Matter of fact, I think it pretty much closed right on it on Friday. So this is something I just love about price action. If you know what you're looking at, it can tell you in advance where price is going pretty much to the dollar. I mean, that's like what is happening right here with semiconductors, down 5% on the week. And if we take a look at the daily chart, this was one of the things, earlier in the week, it was kind of getting hung up around this 50-day moving average here, technical level again. But that measured move ultimately was hit. So very, very reliable things, these measured moves from like bear flags or bull flags. If you identify them correctly, if you know how to get the measurement on them, sliced right through that 50-day moving average, right to the measured move. Last week, and I also showed Apple. It's one of the most important stocks in the market. And what I was showing was that it broke this major uptrend. This is multi-month uptrend. That's a serious break of it, but we've also seen some technical buying in there. I'm going to show you what I mean. I'm going to pull up 3C real quick for Apple. And here's the price action. Here's 3C in orange. You can see right in this area here around, 177-ish. You can see 3C positively diverging on the short-term 1-minute chart. This isn't like huge accumulation like institutional money, but what it is technical buyers. And I'll show you why. And here's a daily chart of Apple. Zoom in a little bit. So sliced right through the 100-day, which is actually really close to the uptrend that I had, which is a trend line based on price, sliced right through it. You can see this 100-day. This is where we're getting some little technical buyers stepping in. That's what you just saw in that 3C chart. So if we go back and look at that, there's Apple again. So this is the technical buyer stepping in at that 100-day moving average. Now, when we were looking at semis during the week and they were kind of getting hung up around that 50-day and it was like, are they going to meet this measured move or not? I kept looking at one of the most important stocks in semis, which is Nvidia, right? Its chart, its 3C chart looks totally different than Apple. It was either confirming to the downside or leading price lower, and we got that measured move met on Friday. So you can really see the difference there between Nvidia, which got no technical support, and Apple, which is getting some over here. And I'll just pull up Nvidia on a daily chart here real quick too. So you can see there's the 50-day. So like the stocks, slicing right through that too. Again, those measured moves, they are so reliable. And what they are doing is forecasting, telling you where price is going to go in advance. I mean, that's like the closest thing you get to a crystal ball in the market. So as we move forward into next week, we still do have some measured moves that aren't quite met. Like I said, the NASDAQ and the S&P 500, they both had these bear flags. The Dow and small caps didn't. So we have a little bit more downside to go. It's not that much. I mean, just look at how price is like respecting this. Support, resistance, bear flag, first leg down, second leg down. So it's almost there. Semiconductors, tech, they've all gotten down to those measured moves. And once those are fulfilled, what I'm thinking, I don't have the evidence for this yet, except in a few places like Apple where we're seeing technical buyers. I think we may see some of these averages in major sectors move back to those technical levels. So for like the NASDAQ 100, you can see it here. That's the 50-day. So it's just a little bit below that. So I think maybe we hit the measured move just a teeny bit below that and we come back up to this 50-day moving average, because we do have a lot of these technical levels and seeing technical traders step in. So we may have a tactical long. I don't want to call that yet until I see a little bit more evidence. The first thing that needs to happen is the measured moves need to be fulfilled to the downside, and then we see if we get a close back above these moving averages. I mean, another one like small caps, sitting right above that 50-day right there. So between that and between some of the support I'm seeing in places like Apple, where we're seeing technical buyers, at least technical buyers, not the institutional money that was selling in mid-June, but like technical traders, we're seeing them kind of step in, have a lot of those levels nearby. The relative weakness in VIX is pretty strong right over here. So I think that's really an indication of technical traders looking at those levels. They're not really hedging so much because of those technical levels seen as support. Another real interesting development is high yield credit, which is one, if I had like one market based indicator that I could look at and nothing else, it would be high yield credit. And I have HYG here in blue, very deep liquid product. Institutional money uses this as a proxy rather than S&P futures. A lot of times you have to keep an eye on what rates are doing and ex-dividend and stuff like that. But what we can see over here is a positive divergence. I'll just draw that in for you. So you can see the S&P is making lower lows, and you can see this is making a higher low. So that's a positive divergence. Over here, we have a really bad negative divergence. Actually, we have one starting right here, and then it gets real bad right over here. But now we have a positive divergence, again, on a very short-term time frame. That's why I would call it like potentially some tactical longs. Looking at a little bit bigger picture, what I am starting to see is the market reconnect with that negative correlation it's had with yields. And if we look at the 10-year yield, it's up here near recent highs, which is near cycle highs. So if we go to like a daily chart, it's near cycle highs. And what I was explaining in last weekend's video was it was this decline from October highs in yields that really kickstarted the whole rally in equities from October till present. But in the summer, and since the S&P crossed above 4,200, this rise in yields would have normally sent stocks lower. But because of the short covering over 4,200, the performance chasing, the FOMO, all that stuff, pretty much ignored yields all summer. Now we're seeing yields back near those cycle highs when the S&P was 20% lower, the NASDAQ was 40% lower, and we're starting to see yields kind of reconnect, or that negative correlation with S&P reconnect. So if you look at this chart, it's basically S&P futures over here, and this is the 10-year Treasury futures. So yields trade inversely to that. And you can see this really tight positive correlation with Treasury futures until the summer, where it's like negatively divergent over here. This is what I'm talking about. But now, if we look at it more closely, we're starting to see this correlation reconnect. So here we are on a more recent 30-minute chart. Again, S&P futures and 10-year Treasury futures. And you can see as the Treasury futures are going down, yields are rising. Now we're seeing stocks reconnect with that correlation that's really been in effect since the Fed started hiking rates in March of 2022. So that means to me that we probably do have a lot more downside to go in the big picture, but I'm looking for a tactical bounce first. I do think that we are going to see a recession, whether it's the end of this year or the start of next year. I think most economists are expecting a recession in Q1 of next year. I think it could be Q4 of this year, it could be Q1 of next year, but I think the whole phase 2 idea is that the market is going to start paying more attention to these recessionary things. We're seeing it in labor. Labor's starting to break down. Services, which has been really strong, is starting to break down. If you look back historically, an inverted yield curve has never failed to predict a U.S. recession, and we have the most inverted curve in 40 years. And since 1945, the S&P has never bottomed before the start of a recession. So there's a lot of people that want to say, this time's different, and of course we've had this spectacular rally and everybody's feeling bullish, but these are just, facts, and you base probabilities on facts. What's ironic is that if we do get a short-term bounce, a tactical bounce, where we can go long for some short-term trades, it would actually help fill out some big topping formations. June, we saw selling in the mega caps in 3C, and then after that, we're seeing trendline breaks. I'm not going to go so far as to say Apple is the market, but if there's one stock that's probably as important as you could get for the market, it's Apple. And we have this big uptrend, right? In June, we saw distribution over in here, institutional money selling into strength, exactly what I said when it was happening. Now we have trend breaks. Let me just show you the most important sector, the most influential sector is technology. Again, trendline break, just like Apple. But let me show you something from a little different perspective. Okay, so we saw the change in character in 3C over here. We saw institutional money selling into price strength. Now we see trend breaks, so prices below where they actually got out in mid-June. And if we look at it from this perspective, there's two different things that could happen. We could get a little bit more downside and come down to like this 164 level in XLK technology sector, or we could just stay right here basically. But either way, let me just draw something in for you real quick. I'm going to move this over, make some room. So when I say it's ironic that a bounce to a lower high could actually make a bigger topping formation, which would be a head and shoulders in this case. The volume is right for the pattern, and it's a kind of a particular volume pattern that you need to have a legitimate head and shoulders. So far, it's right. So a tactical bounce could be played on the long side, but I do think it would probably be ironic that it would be making a bigger top. So those are thoughts as we see stuff in the week, and this is why it's important, I think, to get some context. If you're a subscriber, it's even better because you see it as it happens. If we get the confirmation of these things, then we know what we're looking for. We know what we're looking at. With semiconductors, like I said, we knew where the price was going way before it went there, a week before it went there. So that's the hypothesis. We look for the evidence, and then we can act on that. But I think if there is going to be a time to get short, I would want to do it not as prices are coming down. I would want to do it on a bounce to a lower high. So we'll see if we get that, but that all starts with next week. We gather the evidence and we look for the path of highest probabilities. So that's going to do it for this video. Pretty quick one. Check out the website, Wolf on Wall Street Trade. You can subscribe there, still get 2008 prices before we move to the new website, the Technical Take. You can check that out too. There are some free posts up there, some subscriber posts that I put up on the technicaltake.net. But we are not accepting new signups there yet until we move to the new site. So you can subscribe at Wolf on Wall Street now, get 2008 rates. When we move to Technical Take, the prices will go up a little bit. Everybody have a fantastic weekend.